Tax considerations for mergers and acquisitions. Mergers and acquisitions are about more than just a change in business ownership at a hefty price tag. They require planning and a clear tax strategy. Even though the terms are often used interchangeably, these are two distinct ways of combining companies. Generally, a merger refers to the process in which two firms join to become a single entity. Acquisitions, on the other hand, occur when one business purchases and takes over another and becomes the new owner. This usually happens through stock or asset sales. In the former, a buyer purchases an entire business, with its liabilities and assets. The latter means only specific assets are bought, like intellectual property or business segment. But both present a number of tax considerations. For starters, did you know that the structure of the deal will dictate whether the transaction is taxable or non-taxable? If it's an asset purchase, it's considered a taxable event for the seller, who recognizes a gain or loss on the sale of individual assets. So the sale can be subject to ordinary income tax rates or capital gains tax rates. Some assets are also subject to sales taxes when they're transferred. On top of this, the purchase price can affect the tax basis and future depreciation or amortization. So what about stock purchases? These are often non-taxable for the target company because the buyer takes ownership and doesn't recognize a gain or loss on the sale. Instead, shareholders will recognize a gain or loss once their stocks are sold. But it's not all doom and gloom. There are potential advantages too. It's possible to use net operating losses from the purchase company to reduce future taxable income. It's also worth noting that mergers and acquisitions don't affect tax credits or deductions from the target company. These can be preserved and used to save money down the line. Still, mergers and acquisitions can be tricky. You see, tax liabilities from the target company will be deferred to the purchaser, which can significantly impact their tax obligations. To make the most out of the potential benefits and lower the risk of liabilities, you'll need a proactive tax strategy, which starts with effective due diligence. We can assist with that. With years of experience across industries, we're ready to help you take your business to the next level. If you need guidance, we're just a call away.